Good morning and welcome to The Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, February 20th, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the big story dominating conversations is the surge in oil prices. The global oil benchmark, Brent crude, has pushed further above $70 per barrel, hitting its highest level since summer. This is creating ripples across multiple sectors as traders assess the implications for inflation and consumer spending. We're also seeing some notable divergence in retail earnings. Walmart reported strong holiday growth, but their earnings outlook fell short of estimates, which is raising questions about margin pressures in the retail space. On the flip side, Wayfair posted its first annual sales gain since 2020 and actually outperformed the overall furniture market, suggesting some selective strength in home goods. There's also growing concern around competitive pressures in certain industrial names like First Service and Trex, while tech stocks have been regaining their footing after recent volatility. What's particularly interesting is how the market is digesting these mixed signals, with investors trying to determine whether we're seeing sector rotation or broader economic softness.
That's a significant development with oil prices. How are you reading the market's interpretation of these various signals?
The market seems to be pricing in a more complex narrative than just inflation concerns. Yes, higher oil prices typically raise inflation worries, but what we're seeing is more nuanced. The strength in Wayfair, despite broader furniture market weakness, suggests that well-positioned companies with strong e-commerce platforms can still capture market share even in challenging environments. The Walmart situation is more concerning, because if a retailer with their scale and efficiency is struggling with margins, it raises questions about the broader consumer health. What I'm watching closely is how this plays into the Fed's thinking, especially with key inflation data coming out today. Traders need to be selective here, focusing on companies with genuine pricing power and operational efficiency, rather than chasing momentum. The oil price move also creates opportunities in energy stocks, but you need to be mindful that geopolitical tensions, particularly the fears around US-Iran conflict that are driving prices higher, can reverse quickly. The key trading implication is to maintain flexibility and avoid overconcentration in any single theme right now.
That selectivity is going to be crucial. Steve, let's get into the economic numbers. What's the picture looking like from the data perspective?
Thanks, Robert. We've had some important releases earlier this week that are worth noting quickly. On Tuesday, we got housing starts and building permits data, and housing starts came in at 1.404 million, which actually beat the forecast of 1.33 million and was up from the previous 1.322 million. That's a positive signal for the housing sector, showing some resilience. We also saw durable goods orders on Tuesday, which came in at 1.4%, missing the 2% forecast and down significantly from the previous 5.4% reading. That deceleration is notable and suggests some softening in manufacturing demand. Industrial production, also released Tuesday, showed 2.3% growth, up from 1.3% previously, indicating some strength in the manufacturing sector despite the durable goods weakness. Now, looking at today's releases, we don't have the typical high-impact indicators, but we are getting initial jobless claims data, which continues to be an important gauge of labor market health. The previous reading was 227K, and we'll see if claims remain stable in that range. We're also getting trade balance data today, with the previous reading showing a deficit of $56.8 billion. These aren't market-moving releases typically, but they add to the overall economic picture. The real focus for today and the rest of this week is on the major indicators still to come. Later today, we're expecting GDP data with a forecast of 3% compared to the previous 4.4%, which would represent a notable deceleration in economic growth. We're also getting the PCE price index, which is the Fed's preferred inflation measure, with a forecast of 0.3% compared to the previous 0.2% reading. That uptick, if it materializes, could reinforce concerns about sticky inflation. Additionally, we have two consumer sentiment indicators coming out: the Consumer Confidence Index with a forecast of 57.3 versus 56.4 previously, and the University of Michigan Consumer Sentiment also forecasted at 57.3 versus 56.4. These sentiment readings remain relatively subdued, suggesting consumers are still cautious about the economic outlook despite some improvement from earlier lows.
Those GDP and PCE numbers will be critical for market direction. Lizzie, let's shift our focus to the stock of the day. We're looking at Ralph Lauren today. What's your analysis?
Ralph Lauren is a really interesting case study right now, Robert. The stock is trading at $376.84, which is remarkably close to its 52-week high of $380.86. Over the past year, this stock has delivered an impressive 33.2% return, And if you look at the full recovery from its 52-week low of 176.61, we're talking about more than doubling in value. That's exceptional performance for a consumer cyclical name. However, the stock has only gained about 4% year to date, which tells us we're in a consolidation phase after that strong run. Now, here's what's important to understand about the current situation. Ralph Lauren recently reported earnings that showed slowing sales growth compared to previous quarters. This deceleration is a yellow flag, not necessarily a red flag, but it's something we need to monitor closely. Despite this slowdown, the stock has held up remarkably well near all-time highs, which suggests the market still has confidence in the long-term story. Looking at valuation, we're trading at a PE ratio of 25.64, which is elevated for the consumer cyclical sector, where you typically see 15 to 20 times earnings. The forward PE is 21.09, implying analysts expect about 22% earnings growth, which would justify some of that premium. The price-to-book ratio of 7.91 is quite high, reflecting the intangible value of the Ralph Lauren brand. But it also means there's limited margin of safety if things deteriorate. 16 analysts cover this stock with a consensus buy rating and a target price of 404.76, giving us about 7.4% upside from current levels.
What's your take on whether this is a buying opportunity given the recent pullback on earnings?
This is where it gets nuanced. Ralph Lauren has several things working in its favour. The company has tremendous pricing power in the premium luxury segment. They're expanding aggressively in high-growth Asian markets, and they've demonstrated solid operational improvements that have driven margin expansion. The brand equity is undeniable, and in luxury goods, that matters enormously. The opportunities here include continued Asia-Pacific expansion, where luxury consumption is growing, digital transformation through e-commerce and direct-to-consumer channels, and the ability to pass through inflation due to their premium positioning. However, we need to be realistic about the risks. The sales growth deceleration we just saw could continue, especially if we hit broader economic headwinds. Consumer spending on discretionary luxury items is vulnerable to economic uncertainty. The stock is trading near all-time highs with premium multiples, which means there's limited downside protection if sentiment shifts. There's also intense competition in the luxury apparel space, from both established European brands and emerging players. My assessment is this is a qualified buy for investors seeking exposure to premium consumer brands with global reach. But it's not a slam dunk at these levels. If you're looking at year-end targets, the base case of reaching analyst targets around $400 to $410 gives you 6 to 9% upside. A conservative scenario, where sales deceleration continues, could see consolidation in the 350 to 380 range. An optimistic scenario, with strong holiday performance and international momentum, could push us to 420 to 440, which would be 11 to 17% upside. I'd say this is more appropriate for core portfolio holdings rather than aggressive growth positions. The key is watching quarterly earnings for sales growth trends, international performance metrics, and margin sustainability. If we see sales growth re-accelerate, this stock could easily hit 420 plus. If the deceleration continues, we could see multiple compression back toward 340 to 350 levels. So it's not about buying the dip aggressively, it's about building a position gradually if you believe in the long-term brand strength and international growth story.
That's a balanced perspective on a quality name at premium valuations. Let's move to crypto. Lizzie, what are you seeing in the digital asset space heading into next week?
The crypto market is showing some concerning signals right now, Robert. Bitcoin is trading in a bearish to neutral environment. We've seen significant outflows from Bitcoin ETFs, with $133 million leaving these products as sentiment remains in extreme fear territory. Bitcoin is consolidating and approaching what analysts are calling a turning point, with $70,000 coming into focus as a key technical level. The interesting dynamic here is that treasury bills are being identified as a primary driver of Bitcoin's price, which shows how much macro conditions are influencing crypto. There's also a notable bottom signal that preceded a previous 1900% rally that's flashing again, but given current sentiment, that's more of a longer-term consideration. Institutional investment has been pulling back as evidenced by the ETF outflows, while retail sentiment remains cautious. For next week, I'd characterize Bitcoin as neutral to bearish with potential for some near-term upside towards 70k, but the overall environment suggests caution. Ethereum is in a more definitively bearish position. We're seeing a bear pennant pattern that technical analysts are pointing to, with a potential target of $1,100, which would represent significant downside from current levels. The Ethereum Foundation is focusing on quantum readiness and gas limits as 2026 priorities, which are important long-term developments, but don't provide near-term price catalysts. Ether has seen substantial outflows along with other altcoins over the past 13 months, with about $209 billion exiting the altcoin space. The sentiment here is bearish, and traders should be cautious about catching a falling knife. Solana is showing a mixed picture. Futures data indicates panicked bulls with negative funding rates, and there's potential for the price to slide toward $50. However, on-chain data is hinting at a potential bottom forming. We're seeing some positive developments, like Zora moving to the Solana network, which shows continued developer interest. The $80 level appears to be a key support zone that bulls are trying to defend. I'd characterize Solana as neutral to bearish, with the path of least resistance tilting toward $50, but with some on-chain indicators suggesting we might be forming a base. Overall, the crypto market lacks the fuel for a real sustained run right now. Geopolitical tensions, macro uncertainty, and the extreme fear sentiment are weighing on prices. For traders, this is an environment where patience is crucial. If you're looking to build positions, dollar cost averaging into quality names during weakness makes more sense than trying to catch bottoms. Watch for any shift in institutional flows and improvements in sentiment metrics before getting more aggressive.
Those are sobering assessments across the major cryptocurrencies. Well, that wraps up today's Morning Bell. We've covered a lot of ground, from rising oil prices and mixed retail earnings to key economic data releases today, including GDP and PCE, Ralph Lauren's premium valuation and growth prospects, and the challenging environment in crypto markets. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell and join us again Monday morning. I'm Robert. Thanks for listening.